Well, thank you. Well, that was an amazing speech and a long speech, and I think I've got 5 minutes to respond, so I'll do my best. And it's not surprising it was such a good speech. David's always very thoughtful, and you mention what you think makes a good Monetary Policy Committee member. I think it's independence of thought. Good thought, of course. You didn't put that in your title. It has to be sensible, coherent, good thought. But David clearly qualifies in spades. He's been prepared to be in the minority on the MPC, and that he's now considering whether it's the right time to gradually start raising interest rates demonstrates again that independence of mind. David's time on the MPC is interesting to me because several of the issues he's had to contend with are ones I was concerned with when I was on the MPC, but which didn't come to pass. It's a sort of parallel universe. So early on in my term, in the context of the aftermath of the dot-com bubble, I requested that the bank staff look at the scope for monetary policy when confronted with deflation and interest rates at the zero lower bound. And I think it was Tony Yates that then went off and did some work. And David's speech explains to me why that particular dog didn't bark. And then Paul Tucker and I encouraged work on the neutral interest rate, which was taboo in the bank at the time. And because it concerned me that the two sides weren't as joined up as they could be, I went to court to get permission for MPC members to attend financial stability meetings. Now, the possibility that we would have a separate independent FPC and that there would be an overlap in membership was way beyond what I considered. And of course, those issues turned out to be dogs that didn't bark during my tenure. But unfortunately, they subsequently came to be important. And I say unfortunately because, as the Resolution Foundation will be all too well aware, it's ordinary men, women and children in civil society and not the big actors in this story that have suffered from the financial crisis. David gave us the numbers of the hit on employment, real output, earnings, and they're pretty depressing. So to the substance of the speech, well, I agree with most of it. That's pretty boring for you, but I do. I think David's right to begin considering gradually normalising interest rates. There are some additional risks to the ones he mentioned. I think fiscal policy tightening in the short term. You talked about the headwinds in relation to the neutral rate. The possibility that households will seek to increase their savings more because they still need to do more on their balance sheets. House prices, and also, in my view, the possibility that current low financing costs for borrowers, and especially for lenders, as we've seen in the chart, is encouraging excessive risk-taking. One thing that wasn't covered in the very wide-ranging speech was what your views might be on the timing of unwinding of QE. And I agree with David on the relative merits of monetary policy and regulatory policy in preventing financial crises, and absolutely that monetary policy didn't cause the last one. And I agree also that there isn't an argument there for raising the inflation target, but I do wonder whether there may not be other arguments in dealing with high debt levels for raising the inflation target. And I wonder whether the implication of your argument for not raising the inflation target actually suggests or would imply that perhaps it could be reduced. In relation to R-star, the neutral rate, it's very wise to point out that it's likely well above current market implied rates. And I would just note that both David's adjusted R-star and the market rates imply very low, if not negative, in the case of the market real rates, which again, I don't think real rates were really mentioned. And of course we won't stop financial crises happening, even with those regulatory improvements. And it is important that we retain the ability for policy to respond. And I wondered if David wasn't a little optimistic about the ability of fiscal policy in particular to respond. Absolutely, they were able to respond last time. But I'm concerned that the lesson that politicians seem to have taken from the last financial crisis is that fiscal stimulus and deficits are a bad thing, which could make the government that presides over them unelectable, I fear, for a generation. And that would put considerable onus on monetary policy, so it's encouraging that you're so optimistic about what monetary policy can achieve. And of course, another lesson from the financial crisis, one of many, particularly from the Eurozone, must be the importance of central bank independence, so that it can act as a lender of last resort. And it's encouraging how much the Bank of England has been able to do this time around. So I'm seriously concerned that we, and I mean society and politicians, not macroeconomists, might be taking the wrong lessons from the latest crisis, which will make a repeat of the 1930s more likely next time. I hope I'm within my 5 minutes, but I just want to say that you've been a great member of the MPC, and it would be very interesting to see whether you get that opportunity to be active in August. And I think we should all wish you all the best in whatever you do next. And I would have thought that your work on the MPC and in what we've seen this evening make you an ideal candidate for the FPC. I don't know who selects them.
If you don't know, that's what the chance the rest have got. Thank you, Marion. Was that last question when you said, I wonder if you'll be active at the next meeting? Is that saying, are you going to vote to raise rates next time? Was that?
I would know better than to ask.
Okay, but was it? Were you asking by some other under the radar there? David, do you want to respond to a couple of those points?
Yeah. I mean, it's an interesting question about what you should do with the inflation target, and you raise a question of whether one might actually want to cut it. And there's a certain logic to that, although most of the proposals at the moment are, well, you should increase the inflation target so you've got more room until you get to the zero lower bound. My argument is that central banks have got a lot of things they can do even when they've got to the zero lower bound. And you point out the logical implication of that might be, well, why put up with 2% inflation then? Why don't you go for zero? And that's, there's an argument for that. The argument, I think, why 2% is not a bad number is a kind of boring statistical argument, which you'll know very well, which I think has quite a lot of force. And it runs like this. One of the difficult things in measuring prices is that some of the things we buy just get better. Cars get better. Cars don't rust anymore. Computers get better in a very obvious way. They just get faster and better. And the price at which you buy this stuff tends to overestimate the true inflation rate because it doesn't fully adjust for the massive increases in quality. And when some sort of rather eminent American economists some years ago now tried to estimate by how much on average does the measured inflation rate overestimate the true inflation rate if you took account of the fact that lots of things we buy get a bit better, they reckon it was worth about 2%. So that if you had a measured inflation rate of 2%, that was, give or take a bit, price stability. So that's why I sort of wouldn't rush to move the inflation target. Actually, because the Monetary Policy Committee, as most people know, the Monetary Policy Committee doesn't pick its inflation target. That's the government decides that. They just tell us what we're aiming at, and they say, well, do your best. On the fiscal stuff, I think your concern was that, so this is a question actually for you, was your concern that there might not be as much scope to allow what you might call the fiscal stabilisers to work in the future as there has been ex post over the last few years. That might be a problem. Is that?
Yes, but I mean political scope, not
I see.
kind of accounting scope, because there's clearly, if we go for the sort of surpluses that the government's aiming for, then there would actually be more room than we had. I mean, politically, I think
Right.
it would be seen as an acceptable thing by government to do.
Yes. Well, you know, as you know, I mean, our role on the Monetary Policy Committee is to fiscal policy is set in another part of town, and you know,
But
we're in the East End of London, and there's the West End of London.
Yes, I can say it.
But on that question, and I'm going to bring Kate Bucker in a moment, but just on that, you write that you actually put a number next to the impact that fiscal policy has on the natural normal rate of interest rates.
Yeah.
You say 75 basis points on that's on current trajectory. Can you just elaborate on that, because it's the first time I've heard someone put a number on that.
Yeah, what I've done, and I should be very clear on this, this is not a collective view of the Monetary Policy Committee. This is my own assessment, using some of the models we have in the Bank of England, but using some assumptions I've made myself. So this is not an official Bank of England forecast at all. Anyway, enough caveats. What have I done? I've tried to work out, you know, how much does one think a few years down the road, and I'm talking about a particular point out, I'm thinking about 3 years down the road, when in many ways the economy looks like it might be back in a more normal place, but there will still be some fiscal headwinds because we're still trying to bring the deficit down. I've asked the question, how much might that be reducing growth of GDP at that point? And the answer looks like a little bit. I think, you know, the OBR in their assessment around last week's budget, you know, reached a not dissimilar conclusion. And then the question is, by how much would bank rate have to be lower to offset the residual negative impacts of the remains of the fiscal adjustment at that point? Answer, pretty crude calculation, you know, somewhere 75 basis points, maybe a whole percentage point.
So are you saying it allows monetary policy to be looser, or it requires
Well,
monetary policy?
what I'm saying is, if all you were doing was just setting monetary policy at an otherwise neutral rate, but then somebody said to you, well, actually, you need to be a bit lower than neutral because you're offsetting some slight negative drag from the fiscal side, by how much would you need to be lower? I think it's somewhere around 0.75 to 1 percentage point.
Interesting.
Crude calculation.
Thank you very much indeed. On that note, can I ask Kate Parker to come up and give her response to the comments that we've heard? Kate, it needs no introduction. I'll give you one if you like. But she was...
it's just fine. I'm kind of worried that we'll never get to audience questions. So,
Okay, now we've got plenty of time. I think we've got till 8 o'clock. So
it'd be quite nice perhaps to get Matthew straight up after me.
Fine, will do.
Well, like as Marion, I thought David gave an excellent speech, and unlike Marion, I'm able to testify to what an excellent colleague he was when we were on the MPC together. So it's becoming a bit sort of. One of the things I particularly want to say, and it's in the context of David's speech, is that when he joined the MPC, I rather wished he'd been there earlier, because we could really have done with him in the period before we cut rates right down to 0.5, because during that period on the committee we really needed people on the external side who were familiar with the banking system. We really didn't have anybody, and it would have been much better, I think, had we had David there at that point. I also feel for him on the fact of having been in a period where he's never had the pleasure of being at a meeting that's changed interest rates, because it always feels sort of slightly exciting. And I was reminded of my eldest son, who said to me at the end of a year when we hadn't changed rates when I was on the committee in the mid-2000s, is it a bit of a risk that they might stop paying you if you carry on for so long doing nothing? And so I was always very anxious to point out that apart from changing rates, MPC members do a lot of work in terms of commenting, trying to carry policy thinking forward, and talking to lots of people, and that's partly about building credibility for what the MPC does. And I wanted to say that I think David has also been really exemplary in helping to inspire policy development and help to build credibility in that sense. Like Marion, I find it a bit hard to comment on a speech where I agree with so much. In particular, I agree with the conclusion that we may now finally be moving towards a point when rates will be moved up. And I absolutely agree. The day I was there and we cut rates to a half, I would have thought it inconceivable that 6 years later I would be sitting here and they would still be a half. Given that, saying anything about future rates seems to me a highly risky business. And I tended personally to favour a rise sort of off and on during lots of that last 6 years, partly because I somehow still have a slight residual feeling I don't really like rates being so low. I worry about what it, whether when we come out of this period, we'll find that it has embedded some of the things that people worry about around companies and capital allocation. But on the whole, I think what the Monetary Policy Committee has done has been absolutely right. However, I also sort of disagree with David a bit, because otherwise there'd be no point in being here. I mean, I think one of the comments I would make is you were quite right, of course, to say that monetary policy wasn't out of bullets when we got down to a half. But I remember during my, when you have your last meeting on the MPC, David, of course, is looking forward to this. You get the opportunity to indulge yourself and make sort of a little set of comments to annoy the people who are going to stay when you've gone. And one of the points I remember making was that I was anxious that however much policy did, it would prove very difficult to get the economy back to a kind, rather monetary policy did, it would prove very difficult to get the economy back onto a sort of what we thought of as a normal track in any short time, not necessarily inflation on track, but in the sense to get the economy back on track. And I fear I still think that was true. It was not possible, because of the depth of the crisis, to get the economy back on track quickly. I don't think that means I'm disagreeing with you that all the things we've done in terms of QE weren't powerful, but they certainly weren't quite strong enough. And of course, at the time I'm talking about was before we'd managed to, or the government and the Treasury had got around to thinking about FLS and to trying to resolve some of the other things. Whether that's really monetary policy or not remains a kind of interesting question, but it's certainly a decision in which more than the bank was involved. So I think I would argue that you did need all the parts of the economic policy to work together in order to try and turn the economy around. I also agree with you that we didn't really see some of the improvements until we introduced the FLS, so we did need more than some of the other things. But the size of the shock was absolutely enormous. I think one hopes we'll never go back to that. Marianne's already sort of talked about the question about whether there's a higher inflation target, and you also mentioned Tony Yates. I always think of Tony Yates actually rather curious in this context, because I remember a piece of work he did a long time ago in which he argued that the inflation target should in fact be lower than, I think at the time it was 2.5 when he wrote the piece. I find this quite odd, because those of you who followed Tony on Twitter will know that I think he's one of the people who's now arguing for a higher inflation target, so he's sort of been through a change of mind. I have to say personally, I'm not sure. I mean, David's point about why it's 2 is absolutely, it's 2 in a sense absolutely right, approximating to 0. I have to say I am not quite sure that I wouldn't think in the long run about aiming for a slightly higher rate. I've already made the point that if you have a very severe shock, you're forced into other policies, and they can take a bit of time to work. But in some ways, you think about sort of why 2. I mean, people used to quite often ask me on the committee why 2, to which I used to reply, well, 5 is too high and 0 is too low. You can say that. I mean, I often think when people ask you about something, it's useful to say, well, 0 seems obviously too low, and 5 is too high, because you can tell people how quickly their money will halve. And then they kind of are convinced something in between will be okay, and 2 kinds of seems plausible. But, to be honest, I think 3 would also be plausible. The question is whether the cost of moving to 3, when there might be costs, would be worth having a bit more insurance in the next crisis. And I have to say I was perhaps a bit more open-minded on that. The other question that David really talked about was, which I find really interesting, is the relationship between monetary and financial stability. And I should say, first of all, I completely agree with you, David. In normal circumstances, I don't think monetary policy should worry about financial stability. But of course, the 2 things did get more hooked up together during the crisis, as you sort of correctly said that you thought fiscal policy did too. But the thing that still troubles me about this is looking back on my own experience running up to the crisis, which in fact I talked about when I gave my last speech on the MPC, where I talked about the output gap and really raised the question as to whether the way in which we had then, it sounds awfully old-fashioned because I don't think you really do this much now, whether the way in which we'd thought about policy, which is very simple, if inflation's on track, the economy must be at output, so interest rates must be at about the right level, whether that was really an adequate diagnosis of what you should be doing with monetary policy. And I still think that if I look back at 2003 and the kinds of things that Charlie Beam talked about then, are we building up risks, not in the banking system so much, but in terms of household debt, that we will have to, that will mean that further down the road it will be hard to hold inflation on track because we'll have some kind of shock, was something that we didn't think about. Now, I think your answer to that is, well, nowadays the Financial Policy Committee would deal with all that because they would change what households can borrow at. And I think there's quite a lot of truth in that, but I'm still concerned by trying to divide policy up too much so that one instrument looks at inflation and another instrument looks at sort of household debt and the PRA worry about bank liquidity. And I'm still worried that sometimes holistically there will be trade-offs in this, and sometimes there may be circumstances in which I think monetary policy might helpfully play a role. However, I really wanted to finish by saying that I thought your speech was tremendous, mostly because it was so wide-ranging and brought together so many of the themes you've talked about on the committee, and so many of the things we've all talked about actually in the last 6 years since the financial crisis. And thank you, Gavin, for giving me the opportunity to come and comment on it and say goodbye to David.
Thank you, Kate. As you recommend, we will get straight on with Matthew, who's going to come up and give his response on one of our hosts this evening, and then we'll open it up to audience questions.
Thanks, Simon. A great speech, and a personal and a corporate thank you to David, who's been very kind during his time to the Resolution Foundation and spoken at previous events and spared time for us as well. I particularly liked the title. My own reflection was actually what I would say is that never in the course of monetary policy has one man done so little for so many, which of course has a very serious point, because I think the ultra low interest rates that we've had over the last few years have really been essential in preventing a debt crisis in the household sector, which is obviously what we at the Foundation spend most of our time thinking about. So we had high debt levels and then a very severe and very prolonged squeeze on household incomes over the last few years. And that left households really highly exposed to even modest movements in borrowing costs. Those of you who've been to events of ours before and read our reports might remember that we've done modelling that suggests that if you were to raise the base rate just to 3% over a gradual trajectory, then even with spreads narrowing on mortgages and even with incomes rising, the proportion of households who are highly geared, spending more than a third of their income on debt repayments, would roughly double to over 2 million. So quite a significant number of households in quite a lot of debt stress. So I think it's been very important that rates have been where they have. But I think it's also worth remembering that or noting that the breathing space that this has provided has been really just that. So what we've seen is that interest rates have sort of it's eased the pressure on households, but it hasn't really allowed them to significantly pay down their debts. So in many cases, the exposure that was there still remains. And so we've seen some deleveraging in the household sector, but actually the UK household debt to income ratio is still quite a lot higher than it is in many other countries, including US, Spain, Germany, for instance. And so I think with that in mind, it's encouraging, as David pointed out, that we've started to see a return of earnings and income growth over the last few months. But I think it's important that the corrections we start to see in the base rate, which I think rightly should start in the next few months, that they remain gradual, and that the sequencing of income rises versus interest rate rises is still a key trade-off. And I think it's important too that the banks, that the financial institutions themselves take the continued opportunity that's provided by this window of opportunity of low borrowing costs to make pre-arrears contact with some of their customers, to prepare them for the eventual point at which rates do start to rise in a significant way. And there's willingness among the banks to do that. Whenever I mention it, I have people from the banks coming up to me afterwards saying, how do we do it? The difficulty is making the right intervention at the right time. But I think it is essential that customers are kept informed of what's going on, because expectations might have changed a little bit over the last few years. So there was some data out last week from Ipsos Mori which looked at misperceptions among the public around financial data. It showed that half of us don't know what the base rate is. 5% think it's over 5%, which might have something to do with the mortgage rate they're paying, I suppose, but still not insignificant. And I think perhaps more worryingly, when asked about what the average rate been over the last 40 years, the average response that came back was 4%, whereas the reality is 7%. And 16% of people actually thought it was less than 1%. So 16% of people think that the base rate naturally sits somewhere below 1%, which I think, even taking David's point about the new normal into account, is not where we are. Now, of course, all that might not matter very much if it's true that the new normal is that much lower. But I think it is the case for banks that it's better to be having those conversations with your customers now about what happens when rates rise rather than after the event. And with that in mind, I think there's one group in particular that certainly needs particular need, which is the mortgage prisoners. Some members of that group likely to find it difficult to remortgage in today's tighter credit market. And so the danger there is that they become trapped on their provider's standard variable rates. Now, at the moment, that's not a big deal, but as rates start to rise, obviously, it becomes more so. And I think recognising that group exists, and it's probably a temporary phenomenon, as the stock of debt starts to come off and we have a flow of new borrowers who are used to the tighter credit conditions, then it will no longer be the same problem that it is. But recognising that it exists at the moment actually requires the FCA to stand ready to take some regulatory action in order to protect that group. Our best guess, and this really is a guess, is that up to 2/5 of mortgages are in prisoner position at the moment. But I think that the very fact that they exist highlights a key tension really between the stock of debts built up pre-crisis, which still haven't been paid down, and the flow of new borrowers, and the need to be alert to the fact that we don't want to repeat mistakes of the past. And I think we've talked about already the David's estimate of the extent to which fiscal tightness will act as a headwind to the base rate in the coming years. It means that it's right that we use more macro-prudential tools to prevent future bubbles and to deal with future crises, rather than relying solely on the relatively blunt use of interest rates. But I think those tools have to be wielded in a way that actually is sensitive to the fact that we still have a stock problem. We still have people who are potentially made prisoners by the fact that ratios for loan to values and so on and so forth might hinder their ability to remortgage. But I think more generally, it remains to be seen just how our economic growth model deals with the fact that we are in a tighter credit position now. At the height of the last credit boom, households were withdrawing around about £50 billion a year from housing equity, and an awful lot of that was for households that weren't going anywhere, that weren't moving. So that was going directly into consumption. And I think if you take that level of stimulus out of the economy, that level of demand, then clearly our trend rate of growth is going to be that much slower. And if you look at the OBR projections for the coming years in terms of growth, they're dependent on an increase in this household debt to income ratio. It's projected to reach 170% by 2020, which is higher than it was in the pre-crisis years. And it's not just secured debt. Once upon a time, back in 2010, 2011, when these projections were coming out, that was mainly secured debt. And you can say, well, there's a wealth effect going on here as well. Actually, now a lot of it is unsecured debt. So again, it's about borrowing to consume. If that doesn't arrive, and projections have been there for a number of months now, and the debt to income ratio hasn't taken off, if it doesn't arrive, then really where does our growth come from in the absence of that sort of level of demand? So if we can't generate steady growth without credit, and households can't or won't step up and take on that credit, perhaps we don't want them to, then how do we fill the gap? My vote would be for taking macro-prudential even further, I suppose, a more interventionary approach to the debt mix. So building on the shift towards macro-prudential activity, to use tools such as risk weights, regulation and incentives to generate growth in genuinely productive business investment, borrowing for that purpose, while simultaneously restricting it for the purposes of borrowing against existing assets like housing. Now, other people are talking about that. I don't think it's particularly clear that it's an agenda that the politicians are very interested in at the moment, but I do think it is clear that just a return to business as usual, even in an environment with lower interest rates, is really an option.